In this video, we're going to talk about the balance of payment of a country. The balance of payments records all the flows that cross borders between two countries. There are three types of international flows that will be recorded in the balance of payments. First, we'll record the trade of any good and services that crosses a border, and we'll call them exports if they come from our country, imports if they come from another country. We will record then any income flow, what we have called before net factor payments. These are flows that cross borders that represent an income that doesn't have a corresponding flow of a good or a service in the opposite direction. So in that sense, it's an unilateral flow of income. It could be a flow of profits or it could be a flow of wages, and it can always go in two directions. Either they're coming towards our country, so repatriation of profits or remittances sent by workers that are sitting in another country, or they can come from our country to other countries when they go in the opposite direction, and we'll record them with a minus sign as opposed to a plus sign for the first type of flow. Finally, we'll have capital flows. Capital flows can take many forms, but what is the most important factor to consider is that some of these flows will be inflows to our country, some of them will be outflows. Inflows to our country, we will record them with a positive sign. Outflows, we will record them with a negative sign. Now, here are a few examples of trade, capital, or income flows and how they get recorded in the balance of payments. For example, a Japanese company sells a camera to a German consumer. We call that exports for Japan, imports for Germany. A US company acquires a manufacturing facility in Myanmar. We call that a capital outflow for the US, a capital inflow from Myanmar. The Chinese central bank buys French government bonds. That's a capital outflow for China, a capital inflow for France. A Singaporean worker who's based in Portugal sends income back home to Singapore. That's going to be a positive factor payment for Singapore, a negative factor payment for Portugal. And finally, a Brazilian company repatriates profits back to Brazil, and these profits come from operations in another country, Spain. That's going to be a positive factor payment for Brazil, a negative factor payment for Spain. Now, all these flows typically get recorded into different subcategories of the balance of payments. Now, broadly speaking, this is the way we're going to do it. We're going to collect first all the exports and imports of goods and services. This is what we call the net exports of a country. We then are going to collect all the net factor payments, all the income flows that are associated with either wages or profits or other unilateral transfers. We're going then to collect all the capital flows, and capital flows, we can put them in sort of two categories. Either our domestic investors are changing their holdings of foreign assets, or the foreign investors are changing the holdings of our assets, the domestic assets. Once again, what is relevant is to understand in which case we're talking about an inflow, in which case we're talking about an outflow of capital. If our investors buy foreign assets, we're going to call it an outflow, and as such, we're going to put a minus sign in the recording of the balance of payments. An outflow is also the sale of foreign investors holding our assets. So when the foreign investors sell our assets, this is an outflow of capital from our country, and as such will have a minus sign. Now the flows that go in opposite directions will have a plus sign, and of course this will be inflows of capital to our country. Now typically in the balance of payments, there's going to be a special line that is going to correspond to acquisitions or sales of assets done by either the central bank or the government. This is what is called foreign reserves, sometimes called official reserves. Now, when the government or the central bank buys or sells securities, the logic is going to be the same as before. There's going to be either an inflow or an outflow of capital. An inflow of capital will be when our central bank sells foreign assets. An outflow of capital will be when our central bank buys foreign assets. Now, once we have all the items of the balance of payments in this way, we can talk about the two sides of the balance of payments. The left-hand side is what we're going to call the current account, which is just net exports plus net factor payments. The right-hand side is going to be what we call the capital and financial account, which is a summary of all the capital flows. Now, it happens to be that when we look at the mechanics of the balance of payment, any transaction ends up being recorded twice in the balance of payments. Once in the current account, once in the capital and financial account, or sometimes occasionally twice on the same side of the balance of payments. In fact, if we add up the current account balance with the capital and financial account balance, we will always get 0 in the balance of payments. Now, the easiest way to think about the intuition is to think about an example. Let's think about a country that has a current account deficit, so they need to pay for the imports, finding funds which are not available through the exports they do because they have a deficit in the current account. Now, somewhere in the balance of payments, we have to have a source of income or funds to do this payment. Here are some examples. We could see a foreign direct investment inflow. Now, that's a capital inflow that is going to show up in the capital and financial account with a plus sign. Alternatively, we could see that we are borrowing from foreigners to pay for our current account deficit. It could also be that the way we pay for our imports is by selling a foreign asset. Or it could be that we're paying for our imports by decreasing our foreign reserves. Now, these are 4 or the many alternative ways in which one can fund a current account deficit. What is relevant is in all these cases, what we're going to see is a surplus in the capital and financial account, which is going to match the deficit in the current account. So we're going to have a minus sign in the current account, a plus sign in the capital and financial account of equal size. So when we add up the two, we're going to get 0. In that sense, the balance of payments will always be balanced if we take into account all the trade, income, and capital flows.